Hello and welcome back, guys. So today what we'll be doing is that we'll be doing this particular question called Amberle company, right? So Amberle company is a listed company with divisions which manufactures cars, motorbikes and cycles. Over the last few years, Amberle has used a mixture of equity and debt to finance its investments. What has it done? It has used a mixture of equity and debt, right? So now, however, it is now about to make a new investment of 150 million in facilities to produce electric cars. Okay, so moving into the new sector, which it proposes to finance solely by debt. Okay, so solely by debt, right? So of course there is going to be some kind of change in the capital structure, right? So it's a significant change. What am I even talking about, right? So let's just see the requirement. So we just got a bit of a background information over here. Let's just go to the requirement quickly. Required: calculate the APV for the project and conclude, right? We need to give a conclusion as well, whether the project should be accepted or not, right? So usually in this kind of situation we have the base case NPV is negative, and then basically the financial aspect of it, like financial effect, basically makes it positive, right? Normally that's the pattern, but let's see. So B number, discuss the factors which may determine the long-term finance policy which Amberle company's board may adopt, and the factors which may cause the policy to change. So there is two parts to it. Factors that determine long-term finance policy and the factors which may cause the policy to change, right? So should we be talking about dividend and all as well, or what is it? Because of the debt, right? So let's see. So now the new investments is 150 million. Okay, to produce electric cars solely by debt, right? So other thing is project information. Amberle company's finance director has prepared estimates of post-tax cash flows for the project using a 4-year time horizon, together with the net realizable value at the end of the 4 years. Okay, so it can be sold for some amount as well. Post-tax operating cash flows are there, right? Okay, those are there. And then the working capital of 6 million is not included in the estimates above and funded from retained earning. Okay, from retained earning, and will only be required immediately for the project rising by the predicted rate of inflation each year. Any remaining working capital will be released in full at the end of the period, right? Normally it is released back, right? And yeah, basically we need the inflation rate for it, right? So in order to compute that, inflation rates are given. Sorry, inflation rates are given. And then what else? The finance director has proposed the following finance package for the new investment. So what has he prepared? New finance package, right? So we need 150 million in total, isn't it? We need 150 million. Yep. So bank loan repayable in amount, annual investment over the lifetime, interest payable at 8%. Okay, this is normal bank loan. Repayable in equal annual installments over the project's life. Interest payable is 8% per year, right? Okay. And then subsidized loan from a government loan scheme over the project's life, on which interest is payable at 3.1% per year. Okay, 80, right? We will need that value. And then issue cost of 3% of the gross proceeds will be payable on the subsidized loan, right? No issue cost will be payable on the bank loan. Okay, on the subsidized loan only, right? So it will be what, 80 times 3 by 97 are not allowable for tax. Okay, easy, right? Financial information. So Amberle company pays annual tax rate of 30%, right? We need that information to calculate the tax yield, in which profits arise, right? And then in which year in the same year, the profit arise, so there is no delay. Okay, that's a good thing that they have not given that. Otherwise, in the earlier question there was one issue with that as well, right? Amberle company's asset beta is 1.14. The current return on the market is this much. Risk-free rate is this much. Current return on the market. Okay, so it's not a premium, it's a return, RM. Okay, and then Amberle company's chairman has noted that all of the company's debt, including the new debt, will be repayable within 3 to 5 years. He's wondering whether Amberle company needs to develop a long-term financing policy in broad terms and how flexible should the policy be. Okay, let's go with the APV part first. Right, so Amberle company, right? So we need to calculate first thing what we should do. We should have to calculate the base case NPV, step 1, right? And then the second part will be financing effect, right? So for that, what we need, so let's just see the answering tips as well. So APV is commonly tested. This question is a bit unusual. The project appraisal was very straightforward question, but the financing side effects were more complex than in other AFM APV question. Note in particular how to deal with the borrowing that is paid back in equal annual installments. Ooh, okay. Right, not a big thing. So post-tax operating cash flows are given, right? So all we need to do is add in add in the working capital to it, then we get our cash flow, right? So but in order to do that, what's our investment is 150. What's the realizable value? 45. They have not talked about any TAD or anything, right? That's one thing that they have left out, giving us time to deal with that equal amount installments. So discount factor, right? We need to compute discount factor based on this asset beta that is given. So asset beta is already given. We don't need to ungear it and do all that thing. So we always discount it using asset beta whenever we are doing any adjusted present value based questions. Okay, always. So as you can see, as I've told before, there is a pattern where base case NPV is negative. That's what's been happened over here. So in order to calculate the 12%, how did we compute that? Before we even go to that, we have to calculate working capital. I forgot about that. So it's a 6 million figure, right? That is rising by the rate of inflation. So 6 into 1.08 in the first year. So in the first year, it's 6 million. Rising by predicted rate of inflation for each year. Any remaining will be at the end of the project will be required immediately for the project, right? And then in the second year, immediately for the project, right? And in the first year, what will happen? In the second year, the rate will rise by 6 times your other rate. Where is that? 6 times 1.06. No, it has to be that. It has to be 6 times 1.08. Right, 1.08, isn't it? Working capital of that. Yeah, so it's 6 million in the first year, and then it's going to be 6.48, and then 6.87, and then 7.21, right? So 6.87 into right, 6 times 1.08 plus that amount into 1.06, 6.87 times 1.05, right? 1.721. Right, and then released right now is 6, and then the differential amount between these is 0.48, 0.39, 0. This, and then you add up everything, right? At the very end, you just add all this thing up and you get that amount back, right? Anything else? Discounting factor, right? Discounting factor, we just use the risk-free rate, and then the return from market minus your risk-free rate, right? And then we just use the beta for it. Right, and then discounting factor we get 12%, right? So we discount it using that, we get a value of negative base NPV, right? After that, so the value is this much. So based on this, it should be rejected, right? We are required to comment on it, isn't it? So we just comment on it a bit, and then we move on to financing effect kind of thing, right? So for issue cost, right, so we have to calculate the issue cost after this. So issue cost is basically 3% of the gross proceeds, right? That's only on subsidized loan, isn't it? That's only on no issue cost will be payable on bank loan. So what's our loan? 80 million. 80 million times 80 divided by, let's say, 97 times 3. So 2.4742, yeah, that's pretty much it, right? Issue cost will be there. So always, if you've been given an issue cost kind of thing, if you have to compute it, always compute it as if the 3% of the gross proceeds. Okay, to do that, just multiply the loan amount with times 3 divide by 100 minus 3. Or if it was 4, what you would do? You would do 100 minus 4. Okay, so that's how you do it. Saves a bit of time as well, right? So rather than doing it long way, but yeah, that's how you do it. Regarding this issue cost, right? Another thing that we have is we get a tax yield on it. Let's compute the tax yield. Tax yield is how much? For both the loans we have to calculate, right? So the tax yield, always remember in this case the tax yield is annual. Okay, always people tend to forget it because we have to use some annuity factor as well. So present value of the annuity factor from year 1 to year 4 at how much percent is the borrowing rate? 8% for the bank loan, right? 8%, right? 8%. And then where is that? 80 million, 8%, right? Here this to this, and then 80 million times your 3.1%, 3.1% into 30% times 8%. Let me just open up this thing. Yeah, I'll just open up the, okay, I don't have the table on me right now, but I think, where is that table gone? 8% at, for how many years? 4 years, right? But 8% at 4 years, 312, right? Okay, so that's the tax yield on it, right? So 3.1% only we are getting tax yield on that much amount only, not the whole 8%, not the whole 8%. But we are discounting it at what? We are discounting it at 8%, okay, at the normal rate of borrowing. So we can always mention that, okay? We can always mention that. You see, in that case, we are discounting at 8%, okay? For this loan, right? Because currently the interest in the market is 8% for our normal borrowing rate, right? So that's why we're discounting at that rate. And then and another thing, always remember, so a note to marker here is that full marks will be credited if the tax yield was discounted at a government rate of 3.1%. okay, always state your assumption, and then in this case you can always discount it at 3.1% as well. Okay, so because it's a subsidized loan, so in that case you can discount it at a different rate. Okay, so another thing is I wanted to talk about is tax yield on the bank loan as well. Okay, so what's the annual repayment? Annual repayment is 70 million, is it? 70 million divided by PVA, right? For 8% year 1 to year 4, right? So what's that? 8% is 3.312. So in present value terms, how much will that be? So 70 million will be paying over the lifetime, right? So what's the present value of it, right? So it's this much, right? It's this much, 21 point something, right? Interest payable 8%, so in equal installments over the project's life, right? So we are just discounting it. 70 million times your discount rate. This is 1 by 1.08 at the power 4, 3.312, right? Remember in the thing as well, we use the same discount rate, 3.312. In this case, you want to discount it at 8%, okay? So year one, right? In the year one, what happens? Your opening balance will be, the principal amount will be that much, right? So then you have to add the interest amount in it, right? So how much will that be? Basically 70,000 into interest amount is how much? 8%. Where is that given? 8%. Yeah, 8%. So 5,600. The repayment amount will be how much in terms of the repayment amount is this much, right? Repayment amount is this much, and then after that we just pay in the same repayment amount every year, right? So the closing balance will be this much, right? So what is that? That's your principal amount, right? So at the end of which year, where is that gone? So in the next year you do the same thing, opening balance, you add in the interest on it. So 54,465 times 8%, so you get 4357, right? And then you subtract the repayment amount, okay? It's like every year annual EMI that you pay, right? So and then you have the closing balance, and then the same thing again in the year 4. What happens? It becomes negative, okay? It becomes negative. So from here all you need to get is the interest cost only, because we are currently looking at tax shield, right? Tax shield on it. Tax shield will be how much? Interest cost, the loan amount times interest amount times your tax relief, right? Tax relief, right? And then what do we do? Since in this case we are discounting, tax relief amount is this much, right? So it's interest cost is 5,600. 5,600 times 0.3 is 1,680, right? Similarly 4,357 times 30% is this much. 3,015 times 30% is this much. 56 this much is 470, right? And then what we do, since these rates are in different times, right? So what do? We discount it at what percent? 8%, using the discount factor for respective years. We calculate all the present value, right? And then after that we add in the total present value, okay? So 1556 plus 1120 plus 719 plus 345, okay? 3740, okay? That's our total tax yield on it. That's the total present value, net present value of it, right? So that's in what? That's in thousands, huh? Don't get confused. That's in thousands. Okay, so that's our tax yield on the bank loan, okay? So you see we are already getting that much of benefit from there. What was our NPV? It was 5.09, right? That's in what? Million. Okay. So we'll basically have a positive thing, I guess. So subsidy benefit, how much are we incurring? Is basically, always don't forget to take account of the tax thing on this thing as well, yeah? So subsidy benefit is 80 million times your 8% minus 3.1%. 8% minus this 3.1%. Did you understand this or not? If you didn't understand, I'll explain it as well. Because you see, the normal rate of borrowing is what? 8%. How much are you getting the loan at? 3.1%. So what's the benefit? It's the differential amount, right? So that's the difference amount that you didn't have to pay. That's the amount that you saved, right? So we just do that. That's what they have done as well. And then into 70%. Why did we do 70%? Because remember, the subsidy benefit that you're getting, you have lost a tax shield on it, right? If you had like 8% on it, you would be paying like less tax on it, right? So basically what has happened, this is net of tax, okay? We have to compute it as a net of tax, okay? So 8%, right? So at 8% you would have basically paid less tax. But since you are receiving the subsidy, you are only getting how much? You are only able to claim 5 point something percent, right? So 0.8% minus 8 minus 3.1, 4.9, 4.9% worth of thing, right? So you are only able to claim that much. And out of that as well, you are only able to claim 0.7. So 3.43. 3.43% only you are able to utilize. Okay, that's the benefit you're getting, actual benefit, net benefit, net of tax. This is without tax, this is with tax. Okay, if you didn't understand, do comment down below. I'll definitely be happy to help you help you. Don't worry, I'm right over here. And then we do the annuity factor. How did we do the annuity factor? We did 8%, a normal rate of borrowing. Okay, and then we got the benefit value of this much, 9.1 million, right? So calculate the financing side effect. Okay, so just adding everything up. So basically we add up all the financing side effect. Basically normally what happens is, basically you could make a heading called financing side effect and then add all them up later on, but this is a neater way. This is like a summary kind of thing, right? Summary. Okay, issue cost was this much, right? Remember, where did we calculate it? Over here. I showed you the way to calculate it as well, right? And in working for, we calculated subsidized loan, and then sorry, you see they have segregated it twice, right? Tax yield on subsidized loan, that was pretty much easy. It was only your subsidized loan times your interest rate, right? So that was 3.1%, isn't it? Tax yield was 3.1% into what was the other amount that we did? It was 30% of it, right? So 30% of that into annuity factor, because it's for 4 years. So at 3.1%, or you could discount it at 8% as well. All right. So that's the amount. Right. And then after that, you could use annuity value for that, huh? And then for tax yield, what did we do? We basically had to do a bit of a calculation over here. All we did was to compute that. We just calculated the annual repayment in present value terms, right? We computed that in present value terms, and then we just paid that annual repayment amount, right? Annual repayment amount. Okay, so basically we did the opening balance, interest, you paid your repayment, and then you had your closing balance, and then we just got the interest from there, and then basically we just got some tax relief on it, discounted it, and then we got the total value, right? And then we have the subsidy benefit. Subsidy benefit is nothing else but the amount of subsidy that you're getting. So basically it's normal rate minus the subsidized rate. That's your benefit. Okay, so it's between 8% minus your 3.1%. So original borrowing minus your subsidized borrowing. Okay, and based on that you got 9.088, and then the total financing side effect is 12,818. So basically 12.818, right? 82. And then the financing this project would add around 12.82 to the value of the project. Adjusted present value of the project is around 7.73. How did you get that? 12.82 minus, I think 5 point something, 5.09, 7.73. Okay, that's how you get that. That's how you get that. That's how you get it. Right, 7.73. So the project should be accepted. I'm just tired of this color. Let's just change it. Okay. So another thing that we can always tell is sensitivity analysis should be undertaken on all significant variables. Further analysis may be needed, particularly of the assumptions which lie behind the post-tax cash flows. Okay, post-tax cash flows, such as sales, tax rate, the realizable value of 45 million may be questionable. Right. On the other hand, the time horizon of 4 year seems low, and analysis should be done on potential cash flows beyond that time as well. Right, there could be some cash flows beyond that. So yeah, and they could possibly have a option to follow on as well, right? So it could be there. So Amberle board can use various principles to determine long-term policy factors, right? And then long-term policy factors, basically there are various principles for it, right? May aim to follow consistent long-term policies. Okay, consistent long-term policies. They may have preference which change as circumstances change, right? At present, Amberle company is using a mix of finance. Remember in the question they told us in the beginning itself. You want to see? Let's show it. In the beginning itself they told us somewhere here, yeah, mixture of equity and debt finance, right? They told us over there. And then after that, so are raising the question of whether the directors are aiming for optimal level of gearing, or there is a level which they do not wish gearing to exceed. If the board wishes to maintain gearing at an optimal level, this is likely to be determined by the balance of risks and advantage. Okay, so it's always determined based on the risks and its advantage being it's being cheaper. Okay, the main risks are not being able to maintain the required level of payment to finance providers, right? So that's another big thing that happens when you take a lot of debt. So interest to debt providers or required level of dividend to shareholders, remember. So when you're paying out a lot of debt, right, basically you'll have a lot of interest. You won't have any money left to provide as dividend to shareholders, so they might not like it. So advantage may include lower cost of debt. What are the advantages? Lower cost of debt, tax relief on finance cost as shown in APV calculation. On the other hand, not being legally required to pay dividends in a particular year, right? So basically it's not legally required that you should pay a dividend as well. Another issue is whether board has preference about what source of finance should be used, right? So one example of this is following the pecking order of retained earnings. So pecking order theory basically says that you need to use retained earning and then go for debt, then only raise money from equity, right? So basically the board may prefer this pecking order on the grounds that avoiding a new equity means that the composition of shareholding is unchanged, right? They could basically prefer debt. Why? Because it basically does not dilute any shareholdings and all, or because retained earning and longer term debt are just low risks. Long term debt are just low risks, because the market will assume that an equity issue is being made because directors want to take advantage of shares being overpriced, right? So there could be a speculation from the market, right? It will assume the equity issue being made because directors want to take advantage of Amberle shares being overpriced. Okay, other specific source of finance may have benefits which attract directors, or drawbacks which deter them, right? Other specific source of finance may have benefits which attract the directors, or drawbacks that which could deter them, right? So the investment highlights the aspect of whether the board prefers to match source of finance with specific investments. So it's always a good idea, this thing as well, right? So matching sources of finance with specific investment. Matching arguably gives higher flexibility and avoids committing Amberle company to a long-term interest burden. However, to adopt this approach, the board will need assurance either that the investment will be able to meet finance cost and ultimately repayment burdens, right? So it has to basically the investment should generate enough returns to meet the finance cost, and basically that just means the repayment burden, right? Or these can be met from surpluses from other operations. We need to basically figure that thing out as well. Otherwise, if you have a debt over here for, let's say, a house, right, and then you have a loan particularly for this asset only. The asset is generating income, right? So is this loan housing rent enough to pay your loan, or you have some other business that has to chip into that loan, right? So that's what the director has to uh, basically take into consideration. Okay, right. And then changing long-term financing policy, right, as well as deciding what financing mix or sources of finance they desire to use. The directors will also need to consider what factors would cause this decision to change. A major change in scope of operation, with investment required being paramount, may cause a change in financing policy, right? When the scope of any operation changes, there is, like, when it is very important, we have to change the financing policy, right? Here the 150 million has been financed entirely by medium term debt, right? Medium term debt in 4 years, right? For 4 years. So Amberle company may have chosen solely to use debt if it had made a recent equity issue and does not feel it can make another one soon afterwards. In addition, if Amberle company expands its manufacturing of electric cars, it may decide to sell off its motorcycle or cycle divisions if they are performing less well. If part of the business is sold, the sale proceeds could help finance new investments, right, in the cars division, right? So they could do that as well. So the board may also be flexible at times and take advantage of whatever source of finance seem to be offering the best terms. Okay, offering the best terms. They could be flexible on that. Right, here the board is taking advantage of loan finance being available at a low cost thanks to the government loan scheme, right? The change in the business or economic environment may also lead to the board rethinking how the company is financed, right? An economic recession leading to a fall in share prices may mean that the result of a share issue are uncertain, right? Because people don't want to, basically, why would you buy a share if, like, the market price is falling down every day, right? You won't be making profit, right? On the other hand, an increase in economic or business risks may mean that the lenders are less likely to lend at acceptable rates or will impose greater restrictions, right? So there will be greater restrictions. There could be conditions, and then they will demand higher rates. So if the directors are risk averse, they will not seek any finance during a recession. So during a recession, you try to avoid it, right? If the directors are risk averse, okay. But instead rely on retained earnings to finance any expansion, right? So what are we getting? Working capital, we are getting this much, 2 marks, right, for it. Okay, 1 marks for discount rate. That was quite easy, right, because we'd been given beta asset beta. Base case NPV is 2 marks. Okay, issue cost is 1 marks. Tax shield subsidized loan is 1 marks. You see, bank loan consists highest marks over here, highest marks, because it had a lot of computation, right? So subsidy benefit is 1 marks only. Adjusted present value was 1 marks only because it's just adding it up after that, right? Basically, comments and conclusion were also given, so that's why we had 2 marks for that. Okay, you see, comments, Remember, we commented that the base case NPV, with the base case NPV, it was not suitable to proceed with the project, right? But instead, like after the adjusted value was calculated, it seemed very promising, right? And then you could even write, like in that case, like how much of that benefit is coming from tax shield, like what percentage of the benefit. Okay, so that's pretty much seen in other question as well, right? So sometimes you might well write it as well, so that we gain extra marks. So factors determining long-term policy, we discussed on that as well. And then we discussed on factors which would cause it to change, right? So we could talk about economic situation and all, right? And then basically what's the preference of them, and then basically optimal level of gearing, and then on the best terms and all, right? Based on that, the policy should be changed, right? And what else? uh, so basically selling one thing off, right? So selling one thing off in terms of freeing up resources. If one unit is not producing well, right, that could generate some funds as well. And then what else? Basically this is where we talked about what we talked about, the level of dividend, and then how that is going to uh, how dividend is going to be impacted, and then the interest rate, right? Interest and its impact to shareholders. We talked about gearing, right? And then in this thing we talked about pecking order theory, how it should basically fund its, right, pecking order theory, right, which sources to use as well. And then the investment, basically we talked about matching over here, matching and how we should determine it, right? We talked about that. And yeah, that's pretty much it we talked about, right? So yeah, if you have any confusions, do comment down below. I'll definitely help you out, right? So yeah, that's it for this video. Do like, share and subscribe. Thank you. Take care. Bye bye.